Hey everyone, thank you so much for joining us today. We get started here in just about a minute or two. That way we allow anyone that's joining on to have an opportunity to get settled in before we go through the presentation. We're really excited to give you this market update. We've done a lot of research on it and we would have to say it's good news. So I see a few people are still logging in. We're going to go ahead and get started in a minute or two. So thank you so much for joining us. If you have any questions before we get started, make sure to use our question box. It should be on the right or left-hand side of your screen. You can also raise your hand in the presentation if you have a question. Feel free to ask questions during the presentation and we can answer them live. I'm seeing a lot of familiar names and some new, so welcome. Thank you guys for joining us. We're going to get started here in 1 minute. We'll be going over the market presentation, and if you're just joining us, we are very excited to give you this news. All right, it's 12:02. We'll go ahead and get started with the market update today. As you know, we have our featured speakers, Wade Como, our CEO and founder. And we also have Jeff Johnson, our Director of Lending.
Hello, everybody.
Did you guys want to start out with anything today?
Oh, I think I'm ready to move into the presentation. It is, to your point, very positive news overall.
Yeah,
Very
I would like
exciting.
to say I'm a little upset. I kept hearing about some kind of cold front that was supposed to blow in over the weekend, but it is not cold.
Maybe that's a relative term, Jeff. It's 108.
I guess. I'm still waiting. Brought my jacket and everything.
So before we get started, we do have our disclaimer that we have before every webinar, and that is that the information we're presenting to you today is basically it's information that we find useful. We think it's going to help you going forward in your investments, but do your own due diligence before getting involved in a deal. Make sure that you are the one analyzing your deal before moving forward, and this information is to help you, but not to guide you all the way. Okay? Wade, I think maybe you want to take this slide.
Sure. We often cover a lot of the same information that we covered in previous webinars, but this is a new report, or I guess analysis that I felt was important for us to cover, which basically there is this MCAI report, which analyzes how easy it is for mortgage borrowers to get access to credit. And some of the numbers we're going to talk about here, month over month adjustments, aren't as significant as the overall chart I do want to show, but you can see that mortgage availability actually increased from June to July, which does give an indication that mortgage lenders are feeling more comfortable overall with the real estate environment. You can see that this 1.5% increase does not seem like a huge number, but it is a move in a positive direction because it was dropping since the beginning of the coronavirus. And then credit availability is still 30% lower than it was a year ago. So what that means is you as a borrower, it may be a little bit tougher for you to get access to credit. Now, I do want to remind everyone that there are two potentially limiting factors for that access to most loans. And we're talking about traditional terms of lending, right? Traditional types of lending, conventional loans, FHA loans, VA loans, things of that sort. So the first thing is the government-sponsored entity and their underwriting guidelines. Then there are also overlays, which could be additional guideline requirements on those loans. Some lenders do not have overlays. For example, we do not have overlays on the Fannie Freddie guidelines. We honor their guidelines. Other lenders have more extensive overlays, which can make access to credit even more limited. So let's look at that next slide. And so this is one of the reasons that we feel confident about where national real estate is going. If you look at this chart, it shows back in February 06, which is the time whenever, right before the mortgage meltdown, which happened, 08, 09. The access to credit with all these different types of loans was absolutely astronomical, right? And we mentioned earlier that recently there has been a drop in access to credit, which you can see on the far right of this chart. There was a drop and then a slight uptick, but at no point in the past several years have we been anywhere remotely close to how easy mortgage credit access was back in 07. And that really caused a lot of the problems because people were in these exotic products that allowed either no income docs or people with questionable ability to pay, or a lot of loans were even products that allowed you to just pay interest only for a very, very long time frame. And whenever that eventually adjusted, it's very difficult for people to make their mortgage payments. So we've not had those products nor that easy access to credit. And that lends us and others to think that the probability of future payments is greater, which means there should not be as big of a problem going forward. Anything to add to that, Jeff?
No, it's just encouraging. I mean, if you look at it, it's been, when you look at the numbers we're going to go through later in the presentation, like it's encouraging that credit has been pretty tight, right? If you look at where it's at the bottom relative to, because I remember a lot of, like back in 08 and 09, like it was hard to get a loan. Like it was not easy. There was a lot of people that were, they were used to, and anybody with a pulse was used to getting a loan. But like back, historically speaking, it was difficult to get a loan back there, and we were getting to that point. Yet we're still seeing some very positive numbers in the markets. So if we're able to have those good numbers and show tight credit as it kind of eases back up, and hopefully, the fear of this coronavirus effect wanes a little bit, it's going to start going up a little bit. But it is encouraging that it's already starting. That's already happening a couple months later. It is funny to see this chart if you go back, just how ridiculously high it was relative to like the 06, 05 days. I mean, it's insane. It's 4x roughly what it is now. Easier to get a loan. It's just it's no wonder we had the problems we did.
I think minimum 4x. If you look, 900 and 126, that's a big number. Okay, so this next slide, we saw a really good article, which we actually sent out through social media. And if you're tied to us on social media, Destiny does a great job of sending out a lot of real value-added content. Also, if you are a person who has signed up with our email blast, you get a lot of that content in there as well. This Forbes article was very exciting. New home sales had surged 55%, which was the biggest gain since 2005 there in July. Very exciting number. Number of Americans looking to refinance because the incredibly low rates jumped 111%. Average home price spiked 6%. And we're definitely seeing this in the Houston market as well. Bidding wars are just becoming very commonplace. I was actually looking at some comps on a property the other day, and there were like no sellers contributions, which a few years back, that was incredibly common at certain price points. But I think that buyers are having to make such aggressive offers that they're not asking things like seller contributions to sweeten the offer that they've made. And I know Jeff was very excited about this last bullet point, so I'll let him cover this one.
Yeah, it's just interesting, right? If you look at it, just read it. It says an average of 1.5 million homes were built each year since 1959. However, over the past decade, 900,000 homes have been built per year. So that's, if you look at that, it's $600,000 homes less per year, cumulative, plus the population since 1959 to now. It's I don't know what the numbers are, but it's a lot more people here than there were whatever, however long that ago, what is that, 60 years ago ish. So it's crazy that there's so many more people, yet we're building fewer homes. So that really kind of leads itself to more of the, I guess, the seller's market that we're talking about.
Yes, extreme scarcity of homes.
Yeah.
And with this article, the bullet point where it references bidding wars have been a fast rule and not the exception. The example in the article was someone that had been putting above market offers in on 9 different homes and had been outbid for all 9.
And I'm pretty sure that was in like Oklahoma, right? It wasn't like,
It was,
no,
yeah, it wasn't Houston. It wasn't Houston, but it was still kind of
but it wasn't
shocking.
like, it wasn't like the bustling metropolis, New York City or something. It was Oklahoma.
Mhm.
And that really plays into this slide, which this is the U.S. monthly supply of houses. And we talked on a couple of previous webinars that 6 months is considered a steady state. That means that the equilibrium between supply and demand is balanced. And if you look at the current numbers, we're well below that 5% number. I actually saw a different presentation that had a slightly different number the other day, but we go to this is a little bit misleading. If we go to the next slide, Missouri. Yeah. Whenever we get to Houston in a moment, we will see that number is 3%. There's another slide that we're going to cover.
I think these are months, right? This right here, these are months of supply. So, so like basically what the numbers is if nobody listed any more homes at all and we just sold the current inventory, how long would it take to buy all the houses? And as you can see at the high, it would take over a year. At the low, it's at 4 months, and it's right now it's kind of heading towards that direction.
And you can see we talked about the mortgage crisis. If we can go back to it for one moment. We talked about the mortgage crisis, which took place in 07, 08, 09. To reiterate, that was a mortgage and real estate related issue. This is a health related issue, right? It's a health crisis more than a real estate crisis. And that's just showing in the numbers because because there were so many foreclosures in the market and there was such a negative perception of real estate that even though the inventory was above 7 months at one point, it jumped up to above 12 at that point. And we're seeing the exact opposite thing happening at the moment because there's a inverse reaction where supply is just dropping and demand is increasing at the same time.
Sorry, Destiny, I know you keep going back and forth.
Yes.
So Housing Wire, right? I'll do this one. So Housing Wire nationwide, they came out with an article. The median home prices grew in 96% of the metros in Q2. That's insane when you think about it. 96% of the markets, home prices are going up. The national median existing single-family home was 291 in Q2, which is up 4% year over year. So again, like when you think about everything that's happened this year with coronavirus, and we're still seeing prices go up 4% year over year, it just shows that, like I said, it's more of just a health crisis more than a housing crisis. And I think people are they're starting to see that. Plus, historically lower mortgage rates, inventory, and new buyers hitting the market, housing prices won't be going down anytime soon. So you do have, and I think a couple presentations ago, we talked about the millennials, how they're hitting, like the average millennial is like right at the home buying peak. I think the early 30s are when people buy their first home or when they're at their home buying peak. And the millennials, who are like, I believe, the largest generation ever, the average age for that group is 31. So there's going to be a lot of folks, looking to buy houses with low rates and low inventory. That's just, prices are going to shoot right up.
And this is the HOR update, which we do cover on every one of these presentations because it is Houston Association of Realtors. This is very up-to-date data, as well as being covering the Houston market, which is where our home office is. For those of you who do not know, we do lend across the state of Texas, especially the major metros, but we are based here in Houston, so we're going to cover that today. But this first statistic is really amazing. There were 10,175 single-family homes sold in July. It's a 23% year-over-year increase. But maybe the most incredible thing, in my opinion, is that the previous record, through all the times that they've kept these records, and I think it's been decades, there had never been a month where it was over 10,000. So it's almost a 10% increase over the all-time record, but you just don't see happen that often. Normally there are nominal increases when statistics have kept a long time, and it's a very large number. It's not like we're going from 10 to 11. We're going from 10,000 to 11,000 nearly. So just a incredible amount of activity taking place. And whenever you couple that with the fact that inventory is very low, seeing where prices are going to go from here on out for the remainder of the year, it can only go up. Jeff, you want to cover a few of these other ones?
Sure. So I remember a couple episodes ago, we were talking about the luxury market and how it was just getting beaten up, and it seems to have rebounded nicely. So if you look, they segmented the stats out. I just want to reiterate what Wade was saying. Think about that. We've never eclipsed 10,000, and we had the most units sold ever in a single month, and we almost did 11,000. So we beat the record by like 1,000 homes probably. I don't know what the old record was, but I know it wasn't 10,000. So homes between 500,000 and 750 were the greatest percentage increase, 52% more than July. So year over year, there were 50% more homes sold in that bucket. That is a really high number, and it also shows, prices are going up, right? More homes are fitting into that bucket than they did in the past. And if you look at the inverse of that on a couple of slides, it's a couple of slides ahead or after this, the lower buckets are just getting hammered because you can't find houses that cheap anymore. It's just tough. So single family home median prices rose almost 9% to 271. So the median home in Houston market right now is 271. The average price went up 8.5% to 338. So those are some big numbers. And I think, if you would have said 5-10 years ago that the median price is 271 in Houston, that's unfathomable right now, or it was back then. And then year to date, sales are now 2.7% ahead of 2019 record pace. So like again, it sounds like a broken record, but like the fact that we have gone through or are going through the coronavirus pandemic right now, and prices are still 3% almost ahead of last year's record, is a huge sign. But I think Houston in particular, the nation, but Houston in particular is set up for success in the long term.
If I might add to that, I think one thing it tells me is that the coronavirus has not caused a drop in any of these things, a less interest in buying single family properties. It has increased the interest in single family properties. And I think there's several reasons why. We've talked about a few of our other presentations, a lot of authors and journalists who have talked about the same thing. And that is, at this moment when people are often working from home, or they do not feel as comfortable participating in activities outside of their home, there's a big reason to have a bigger yard, more amenities at your home, and to have space for both people potentially to work from home, or a child to work from home, or a variety of other things. And so that is what is driving this economic boom in real estate, because there are countless reasons that even if coronavirus does happen to have a second wave, that I think these numbers, that would not cause these numbers to go down. I think it would potentially only cause them to go up for all of these different reasons that really make a lot of logical sense, right? If you are living in an apartment inside the loop and you are frustrated because you cannot go to the gym there, you don't feel comfortable using the pool, or you are upset that you do not have a yard, all these things make sense. And then also the work from home percentages, I think, are just going to continue to go up over time. And that will necessitate more rooms, larger spaces, etc.
Yeah, we did cover that, and we did find an article where people are shifting outside of the apartment rentals, which I think that couples with the fact that a lot of millennials are getting to that age of purchase at 32. But also the low interest rates are really appealing to first-time buyers. So I think it's kind of a perfect storm.
Absolutely. A couple other horror updates that were very exciting. Sales of all property types, right? This would include duplexes, quadplexes, condos, townhomes, all those types of things, 25% year over year for a new record. The total dollar volume for the month This is a huge number, and I think it's because that luxury market Jeff was talking about is also doing better. 33.8% increase to 4.1 billion in total sales. That's
insane.
That's a huge number. Leases also. So this is a question that people have. I know that people are buying more homes, but how are we doing on leases? But leases, average rents went up, as well as the number of homes that were leased went up. So you see that number going up 1.8% to 1940. That is an indication that not only are people wanting to buy homes, but not everybody can do that. That's moving from an apartment, right? Credit has tightened a little bit, especially in the areas of lower income housing, like FHA has seen more of a change than conventional products have. So I think that it's not as the percentage and how much more difficult it is for a landlord to get a loan is not as increased. It hasn't increased or become as more difficult as it has for an FHA buyer or low income buyer to get a loan, right? So I think that you're going to continue to see more landlords getting properties and then continuing to see people needing to take advantage of that because they cannot buy a home on their own. The other thing to add is just this last bullet, 3-month supply versus 4.2 months last year. We said earlier, 6 months is equilibrium, we're down to 3 months. And with all these other things, the demand being at such a high point, I think that's probably going to be well below 3 in the next several months, which is very, very rare.
Yeah, I was going to say something about the rent. I've talked to a couple of different people that are, because most of the folks that we talk to are buy and hold investors. They buy the houses, they fix them up, and they rent them out. And talked to a couple of them that were leery of buying rental properties because they were afraid they couldn't rent them out right now, which is, if you look at those stats, the number of leases went up 3% and the rent went up 1940, went up 2%. So to Wade's point, I think people are, not everyone can qualify or has the money to purchase their own house, even though they want to get out of an apartment. So, but they want to get out of living in those confined spaces. So they do the next thing, which is rent a house. So I do think that market will be flush with potential buyers or potential renters, excuse me, for the foreseeable future.
And I would just say within our portfolio, and it's anecdotal and it's not a massive sample size, but we have well under 4% of our portfolio that has missed any payments on rentals, which is really exciting. Now, I will say it has been more difficult to evict someone at this time because of all the moratoriums on evictions. It's been more time consuming, a little bit more difficult. That is softening, but just the overall percentage of people who are paying has been impressive and honestly a little bit surprising. But and I haven't seen the current statistics on that, and we don't have that as part of our presentation, but it is pretty impressive to me thus far how many people have been able to continue to pay.
Hey Wade, as a, I know we have a good amount of time still. As a side note, since we do have a lot of buy and hold investors, do you want to kind of give a couple of tips for what you use to choose your tenants? Destiny.
I've got 3 questions for you guys. I've been trying to find a good time to interject. Okay, so before we do that, do you mind if I ask? Because I have one and they pop back in. They're like, come on. So, and you may have answered a little bit of this question already. So this one's going to be from Troy. Troy, thank you so much for being back on our webinars. You are on almost every single one, and I love that you always engage with us. His question is, do you see any indicators that there will be some distressed landlords in the near future? I imagine properties have not had any issues collecting rent so far. However, I am worried that the risk will become greater as the stimulus money and unemployment funds decrease.
I would agree with both of those things. There have been, heavy stimulus packages that this out. I do think that there will be some opportunities for investors to buy from distressed landlords. I think the stronger, and this goes into Jeff's question as well, the stronger your standards are, the better you rehab properties, the higher quality tenants you can acquire, right? And those higher quality tenants have a little bit more of a nest egg, and they do not have to, they're not necessarily living paycheck to paycheck, and they can weather the storm a little bit more easily. So we've always been passionate about feeling good about providing a higher quality property and also getting a higher quality tenant because of the property that we put out. And I don't know that those statistics are accurate for everyone, right? I think that there are probably some landlords who are having more difficulty because they may have not had as high a quality of a property and maybe not had quite the same standards, because we will wait a little bit longer to try and get somebody that we think is going to take care of the home and pay better in the long run.
Yeah, I think like you said, the higher quality your portfolio, the more you can charge, and conversely, you're going to get folks that are probably, because everything I've read and heard is that the majority of people that have been hit the hardest by coronavirus and a lack of income are the more blue collar type worker or retail type of stuff. Your typical white collar worker, most companies have adapted to a work at home environment, except for, there's a few industries here and there, but for the most part, like most professionals have adapted and they're just kind of working from home. So I do think you're less likely to get hit with massive delinquency problems if you kind of have a higher quality portfolio.
Well, and to that point, we'll be going into it a little bit further below, but the CARES Act has now maybe opened up some opportunities for tenants that might be in that situation. If they are, like Wade said, a little bit of higher quality, which I think that's our last slide. So we'll be getting to that shortly. Now, my next question is going to be from Vicky. People are losing their incomes. How long before foreclosures flood the market and cause prices to crash? I keep hearing about the biggest RE crash ever. And there's a lot of capitals in here, so this one's an excited question.
So I would say there is a core fundamental difference in between what the government has stated about how forbearances will be handled in this situation versus 07, 08, 09. And the biggest difference is that in that particular incident, the government did not state that people would be able to tack on the payments which have not been made to the life of the loan. Most servicers require them to pay everything immediately. So if you hadn't made a payment in 6 months or you hadn't made a payment in a year, in order to get back whenever the forbearance period ended, you could come up with 6 or 12 months payments, which honestly is a little bit illogical, right? It's, if you haven't been able to pay for the last 6 months of the last year, what is so fundamentally changed that you are all of a sudden able to, pay 6 or 12 months? Very difficult to do. And there were some modifications, but the process was not very efficient. In this particular incident, the government has said that they expect servicers to allow people to add it to the life of the loan, right? So they are not going to be required to pay them all at one time. So I do believe that that is a major fundamental difference. But secondly, just like we showed earlier, the lack of exotic products, and I think people are now more qualified than they have been in the past. When I mean exotic products, there were products that people could qualify for loans with no income documentation. Back then, there were products that were interest only, and there are a lot of people who are buying homes that they could not pay for, and their only objective was to have an interest only loan, and that the home would appreciate to a point where they could make a lot of money in a very short time frame by basically a short-term hold and then flipping the property, right? But home prices were going up so rapidly in California and New York that people could do that. They put it on an interest only for 12 months, the property would appreciate by 10%, and on a $500,000 home, they'd make $50,000. But whenever the prices dropped and they could not, that adjustment came in, they actually had to start paying an amortized payment. They could no longer afford it. So I think there's so many factors that make me think that while there will be some foreclosures, I see, in my opinion, no way that it would be like it was before. I just don't see that happen at this time. Jeff, anything to add to that?
No, you covered it. I agree. I don't think, I think there will be some of what you're talking about. I think overall, it will not be nearly the hit in severity or duration what most people are expecting or thinking back from 08, 09.
And I have one more comment from Troy. This was written when Wade, you were discussing the portfolio. He said that he read an article recently about Invitation Homes and how they're looking double the size of their 80,000 single family home portfolio right now. So he was just sharing that information sort of to tell you, hey, you're not the only one, everybody's buying.
I didn't understand that exact stat. What can you explain that once more?
He said, I saw an article that said Invitation Homes is looking to double the size of their 80,000 single family home portfolio.
Yes, and I would echo that. I've seen a tremendous amount of articles from hedge funds that are heavily investing in single family right now, and those are very smart individuals usually that have really analyzed all the statistics and what they foresee happening. They would not be going into that market at this time if they thought that there was going to be a huge drop in overall prices.
All right, I think that's it for this slide. Or Jeff, were you asking Wade something? Or we're going back to that, or are we heading to the next slide?
Well, I don't know if you covered or not. If you wanted to kind of do the details of what your standards are, what you look for in assessing tenants.
Mm-hmm. Yeah, so we definitely, I look at the type of job and the quality of the job and how long they have had the job, because I do think the ability to maintain consistent income is a very big thing. Secondarily, we look at their previous pay history, and it's not as rigid as it would be to qualify for a conventional loan, obviously, because these people are not qualifying for that type of loan. But we do think that significant issues with their credit, judgments, bankruptcies, previous foreclosures, evictions, anything that they did not find a way to work out with their landlord or their lender, those are pretty big concerns. And then I also look, do they have the ability to come up with their security? There are some alternatives that I think can be reasonable. There are some products out there that allow people to basically, you purchase an insurance policy and the customer will pay for it. It's like an addition to their monthly payment. But if they don't have the money to come up with 1 month's rent up front, that is concerning, because what happens if one or two of the people in the household lose income for a month, right? How are they going to pay the rent? They don't have the money to come up with a security deposit. So I think a little bit of money, proven pay history, and then the stability of their jobs are things that are very important to us.
One tip on the pay history, correct me if I'm wrong, but a lot of times they're going from landlord to landlord. And if it's an individual, if you just send that individual a request for verification of rent, I mean, if you think about it, if they're not paying, that landlord probably has every reason in the world to lie and say, oh yeah, sure, they paid. So they get out and they move somebody in that's going to actually pay. So if you're getting a rent history from somebody that's not coming from an actual company, and it's an individual, you want to get bank statements or some kind of receipts, or check, cancel check, however they pay, get some kind of actual proof that they made the payments for the last 12 months. Otherwise, you could be just kind of taking somebody else's problem and not knowing it.
Sure. And I think that, as I mentioned earlier, the time frames to evict are longer than they were previously because of moratoriums. So I think people that even have a certain amount of character and try to tell the truth in these circumstances, they may feel so desperate that they, to Jeff's point, say someone's paying when they're really not.
Okay, so this is just kind of summarizing. That's one big nice chart, what we've been talking about in July to 19 to July 20, the total property sales. This is total, not single family, so don't, 13,000, don't get it, what we're talking about. So 13,000 total properties, that's including everything. The total dollar volume, 4.1 million. It's a third increase. That's just insane. Total active listings are down, kind of going what we're talking about, how there's just less supply. Single family home sales up from 8,900 to 10,900. That's the record. Average price went from 311 to 338. The median price went from 250 to 271. Those are 8% increases on both. That's really nice. Like we said, the inventory has gone down drastically. There are fewer homes. And then single family pending sales from 8,300 to 8,300 to 11,000. And then it says single family home sales rose compared to July 19. Pending sales shot up 33%. total active listings and total number of available properties fell 19%. So I did read a little article or a little color from the article from one of the guys at HAR, and he was talking about the fall may be a little slower because there's just not as many available properties. That was the one bit of negative news, was that there's just not enough properties right now. So they think that the activity will be the activity will be less.
For the sales numbers, that is not going to be negative anyway for the prices, right?
Right. The prices will not go down. No, it's more of the activity. If you're looking for if you're looking at just units happening, the price, the number of units will go down. But I looked up, at least for this month, at the beginning, so the number here is 11,185 pending sales. So that's kind of an indicator of what's going to happen next month. The previous month, it was 11,006. So it's pretty much the same. So I would not expect a drastic fall off in August either. When those numbers start going down significantly, then I'll worry about a downtick in units. But I would not expect August to be much different from July.
Yeah, and I think as we see a downtick in units available, we're going to see an even more significant increase in prices, because I don't see demand dropping. I only see supply dropping, honestly. And I do think we're going to continue to see, Houston and all of Texas, honestly, are growing at an incredible rate. And I do think for a wide variety of reasons, including people in general moving towards space. Texas is a spacious state. It's not built vertically as much as it's built out, right? I think that we're going to continue to see people from other parts of the country that may have been more challenged with a wide variety of things, including maybe coronavirus outbreaks and people wanting to have more space for themselves. I think we're going to see that continuing to grow. People moving in, lower inventory, and fantastic interest rates continue to push up prices because your buying power just goes up. You can buy a much bigger house at 2.875% than you can 5%, right? It's just a lot of extra buying power.
Yeah, we haven't talked about the affordability index in a while, but it's for Houston relative to a lot of the major markets, it's really good. There aren't that many cities that can have the same type of amenities that are cheaper than Houston.
Yes. Yeah, this chart, I mean, it's we've covered a lot of the details in it, but you can see just a steady increase from 2015. And whenever you look at this 5-year returns, somewhere between 4 and 5% over that time frame, and that does not include the cash flow that you would have made on your rentals. This is just merely appreciation, and it's hard to find investments that are safe and solid that pay that type of return, right? I mean, the stock market seems to be potentially overpriced at the moment. A lot of metrics like the PE ratio say it is priced as high as it's ever been. But then you have real estate that's just kind of, not even if you're counting, your cash flow that you get every month, $300, $400, $500, whatever it is, you have appreciation that just seems incredibly consistent and steady.
Yeah, I'm looking at this and I'm thinking to myself, like, if I'm going to buy a house, I'm going to buy one in January. Like if you look at these little average dips, they're always in January. I mean, nobody wants to buy a house in January. So if you trudge through the house buying process during the holidays, you'll get a bargain.
Yep, that is definitely true.
So this is kind of what I was talking about last time, or a couple slides ago, with the buckets, right? This is showing the number of units sold in each bucket. And if you notice, basically from 0 to 150, it's down 20 and 29%. I mean, that is counterintuitive to what we've been talking about how much activity is going up. But the reason is that those two buckets are just, prices are going up so much. Those two buckets are becoming non-existent. I mean, I wouldn't be surprised in a couple of years they just combine them, right? I mean, it's going to be so few sales in those two buckets. As you see, as prices start going up a little bit, 150 to 250 still below the average and the median, so those are considered a bargain. Slight increases, and then 250 to 500, 37%, 500 to 750, over 50%, and in the luxury 750 and above, 41%. So those deals are getting closed, and I don't expect them to change that much anytime soon, to be honest.
I would also say that in that 0 to 150 price point, a lot of the buyers are those FHA buyers, and that product type there have been a couple different things to tighten up that particular product, from FICO score requirements going up and a few other things. So I do think that can create, it's unfortunate for those people that aren't able to get into a home, but for real estate investors, that general area is often a price point where if the home has, some distress, it can really present an area where investors want to buy. Most of our investors are usually buying in that 225, 200 and below price point. You're looking at a distressed property. It may be either listed, or if you're doing an off-market deal, unlisted, but probably a lot of them are going to be purchased in that 75 to 150 range.
Yeah.
Jeff's point of the timing, that kind of is a consistent thing. Not only are the prices, but also the number of sales. But while you see the waves going on continually, it is definitely increasing just in total sales. And that's because it's a growing town, a prospering economic story here in Houston, and the total number of sales, while there are dips, those dips are not as low, and the peaks are regularly higher over the past, 5
They're getting higher. Dealers each year, the peak is just slowly a little bit higher.
Yep. Yeah, so this is an interesting thing that, and we are not tax advisors. We are going to have some tax advisors on our call on Thursday. Who I think, yeah, some very intelligent people that are going to be able to talk about a wide variety of things. And I'm sure this CARES Act topic will come up. But there was an opportunity for people who have money in tax deferred accounts like 401ks or IRAs. And you do have to prove distress. And like I said, we're not tax advisors, so you want to read this information and speak with it with your CPAs or tax advisors. But it does appear as though there's an opportunity to take up to $100,000 out of those accounts per person if you have had some type of distress. And to me, it seems very inclusive. Those allowances are. It could be somebody in your family that had COVID, or that you've had a decrease in hours at your work. Maybe you're not making as much in bonuses. There's a lot of different ways in which you can qualify for this. But
there was also one for not having childcare too.
Yes. Yeah, not having available childcare.
It's a wide net, to say the least.
Yes. And normally, if you wanted to take money out of those accounts, you would not only have to pay taxes in that immediate year, but you would also have to pay a 10% penalty. From what we can see, not only do you get to avoid that 10% penalty, you also have an opportunity to either stretch the taxes out over a 3-year period, which is a great opportunity, or to put the money back into those accounts at the end of 3 years and get all the advantages of being able to use that money for a wide variety of things. And once again, we're not tax advisors, but maybe rather than just paying bills with that, you could use that money and use it to invest in real estate to kind of grow your opportunity. So we're not saying that we necessarily recommend that, but it is an interesting topic. There's a wide variety of things that have come out to try and help Americans who have experienced distress to improve their situations. And this is one way which are giving you some extra flexibility. And I think if you could use that to not only just have it going out the door, but to increase your income, like if you've lost a job or other things like that, it could be a great opportunity.
And I will go ahead and put the link in our chat box. So if anybody was interested in taking a look at more on this information, we're going to provide you the link for that. And then to Wade's earlier point, if you have a more high qualified tenant and, God forbid they were to lose their job, this is something that you might be able to direct them at and see if maybe it would help them out to avoid, issues on your side as well.
Sure. So this, all the things we've been talking about, one of the biggest drivers of this positive news is the fact that rates are historically low. I think the last time I checked, it was right around the high 2s, right around 3%. This just kind of shows you where they can be, right? Starting in, I think, the 1970s, we're at 8 all the way up to 18.6 in the early 80s, and then steadily declining. But if you look at the chart, we are at the bottom of it right now. So it literally will not get, I won't say it won't get better, but it's not going to get much better than it is right now if you want to buy a house. Because, you know, one of the things that's driving up prices is this rate, right? If you have a lower interest rate, like it says, you have increase your buying power by $6,000, right? You can afford everyone has a certain amount of income. They say, okay, I can afford this payment. Well, if this payment is based on a rate that's historically low, you can afford more house. So that brings more buyers to the market, or they can afford to pay more, which will drive prices up. So I mean, we have tons of people and borrowers that we talk to that are refinancing their mortgages, getting cash out to buy these properties because they see it as a great opportunity, A, to lock in a low interest rate, even on an investment property, and B, why not refinance your existing mortgage to reduce your payment? If nothing else, you're going to save some money, either monthly or maybe shorten your term. There's so many reasons to do it right now, but this is one of the biggest things driving this real estate economy is these rates staying super, super low.
If you think about it from two perspectives, right? One is an end buyer, person who's going to live in the property, and each half point adjustment allows you to buy about $6,000 more in home, right? So you see these numbers, and I mean, there were times in the not too distant past where interest rates were, even a decade ago, significantly higher, like nearly double. Sometimes if you go back even further, triple, right? So the buying power is so significantly greater, even for people who are making the exact same type of amount of money, right? You can just buy so much more homes. So that allows people to buy up without even wages increasing that much. And then also from a landlord's perspective, you're not just looking at, can I afford to buy this property? You're looking at it, what is my cash flow, right? And cash flow goes up exponentially whenever your interest rate is able to decrease. We're in a very unique situation. If you haven't kind of looked at the rest of the world and how they buy real estate, even for owner occupants, in the large majority of the rest of the world, 30-year mortgages are unheard of. They're much shorter time frames. So, and our government has not only allowed owner occupants to take advantage of a 30-year mortgage, landlords are able to take advantage of that. So it's just a compelling opportunity. You couple that with the tax advantages that the government gives you to invest in real estate, and it's just a really makes sense move. There's a lot of reasons that it can be very positive for you to take advantage of the opportunities that are out there today.
Okay, I'm popping in. I have a question. This one's from Lisa. What interest rates can I look forward to now?
Yeah, so Jeff talked, the interest rate he talked about earlier in the high twos is definitely for an owner occupied mortgage, right? And that's the chart that was provided previously. That's why he was talking about that rate. So if you're looking to buy a property yourself or to refinance a property on a non-cash out basis, we're seeing rates, no guarantees, changes all the time, and it's FICO and other opportunity or other factor driven, but you could get in the high twos. Non-owner occupied properties, we're more seeing in the high threes, which is still amazing. I mean, if you look at you as an investor able to get an interest rate that owner occupants almost have never been able to get through our history. We are going to talk about this little half-point bump.
Yeah, I forgot to mention that.
Yeah, Fannie Freddie has added a half-point bump, which basically means it's a fee that they are charging because they are concerned about, some future foreclosure challenges that they may face. So they're adding a little bit of a fee to the loans that are being originated now. But if you think about that, even with that half-point bump, the rates are still historically low by a large margin.
So just to clarify, when you say half a point, you're referring to half a point in fee, not rate.
Yes.
Yeah.
Yeah. So on a $100,000 loan, we're talking about $500. Really not that big of a deal.
So we do have one more question. This one is from John, and it said, I don't think I'm ready to have my own rental. Is now a good time for flips?
So on our first market update, I was and Jeff was, we both said we do not know exactly what's going to happen with flips, and we really didn't. In all candor, I think there's so much data right now that shows that home prices continue to appreciate. There's incredibly low inventory and low days on market, that I do think it's a very good time to be involved in flips. There's just too much data to the contrary. And then the next question is, okay, because we do not know what's going to happen with COVID. We don't know if there's going to be a vaccine or better treatments, and we don't know if there may be increased cases. Will that have an adverse impact on home prices? And obviously, the severity of it will make an impact if it's a significantly greater problem than it is today. But in my estimation, even if there are a significant increase to cases and it drags out longer, all of the indications thus far say that that's actually only increased prices and decreased available properties. So in my opinion, yes, it is a strong time to do flips.
Yeah, I would say 2 points. I agree with Wade. If you're conservative by nature and you're a little scared, do two things. One, try and time your flip to where the property's not going to hit the market Thanksgiving. Get your rehab done so you can sell the house before the holidays, as the charts show. And just kind of anecdotally, when we have flips, we try and get them on the market before the holidays because activity slows. And two, if you are, because I think flips is a great business to be in, but if you are conservative by nature and you want to cover your bases, get qualified to refinance it as well. So if you go through the process of doing flip and for whatever reason it's not working out, you can always turn it into a rental. And as long as the property cash flows, or it's in that ballpark, you don't have to make a ton of money, just because we've shown that over a long period of time, investing in real estate is a good move. So even if you buy it and you end up holding onto it for 5 or 10 years, that could be a great long-term flip. But get yourself pre-approved for a refinance, so you feel better about the fact that, okay, God forbid things don't go well, I can just refinance, put a tenant in there, they make the payments for me, and I have a lot more flexibility.
I agree with that completely, Jeff. In times that are a little bit uncertain, the more exit strategies, the more solutions you have to challenges that may come up, the better off you are. I don't see anything in the data or how we have responded thus far, the housing market has responded thus far to Corona, to say that prices are going to drop, or that there's all of a sudden going to be a lot more inventory, which would cause prices to drop. But what we do for our customers is we encourage everybody to apply both for a flip qualification as well as long-term financing. It's a very easy process if you were to apply with us, but there are some other hard money lenders that may have the same capability. But knowing all of your exit strategies, if I sell the home, this is what I should be able to do. If I rent the property, I should be able to break even or maybe even make money. If you're in that $300,000 and below price point, which is always the most approachable price point for new investors, you're almost always going to be able to break even at minimum, if not even make a little bit of money. If you get into the higher end flips, you have fewer exit strategies, but as long as you can cover the extra $100 a month or $200 a month, you may be upside down for a year, you still have an out, right? You still have an exit strategy that can be viable.
Yeah. Are we done early today?
That's
the first.
Yeah.
No, Destiny.
Do we have another?
We're never done early. We were close. But first, if anyone is not wanting to stay on for the next few questions, I want to thank you guys for tuning in today. You are going to get a copy of this webinar emailed to you tomorrow once it finishes loading. We'll also have a link to register for that SMD accounting webinar, which will be next Thursday. Make sure to tune in. We're going to be covering 1031s, but you can ask questions live. If anyone else has any questions, pop them in, but we do have one more. This one is going to be from Quinn, and this question said, out of the Texas metro areas, which area is best to invest in? Is Houston the #1 market? Good question, Quinn.
It is a very good question. I don't know that I have evaluated the different towns adequately to say that. I will say that the affordability index is a great place to check. If you go and look, that you can find affordability index by major metro very easily, and that is always a very good indicator. And I can tell you that consistently, Houston, as well as the rest of Texas, always does well on the affordability index compared to the rest of the country. Although I will say Austin is in the it is not as affordable as the other major metros. But I do think that Austin has been a very robust real estate market if you're looking at flips. And they do have a lot of duplexes and quadplexes in Austin that can be very attractive buy and hold investments as well. Sometimes that single family market there is a little tough just because the price points are a lot higher and it's very difficult to get rents that can cover that if you're doing single family. But I do know San Antonio is a very hot market for single family investments as well.
Yeah, I would say flips, you can flip anywhere. You just got to buy it at the right price. For buy and holds, if you're ranking the four majors, I think Houston and San Antonio are consistently a little higher, and then Dallas, and then Austin. Single family. If you go into multi-unit type stuff, it's different, but single family, I think Houston, San Antonio would be 1A, 1B, then Dallas, then Austin. A lot of our Dallas folks, they come buy Houston properties.
Absolutely.
Yeah, actually, our featured speaker on Thursday does that.
Yes.
There you go. Oh, is he from Dallas?
Yeah. He and his wife, and they both invest in the Houston area. We have one more question. This one's going to be from Jim. Does your portfolio include Airbnb? I've been thinking about building a garage apartment and trying to decide to Airbnb versus a long-term rental. What would you say?
So there was, I don't personally own any Airbnbs. I am definitely considering it, and I've been, doing some research and evaluating those options. I do not think it's a bad segment. I do think that there was a time, at the moments when people were most concerned about coronavirus and people were really kind of sheltering in place, that part of the industry did struggle a little bit. But I've seen a real bounce back recently, and I think it's because people are interested in, just like getting away from apartment complexes to live, there's some interest in not necessarily staying in a hotel where you're interacting with so many other people. So it seems like that part of the real estate investment space has really had an uptick recently.
Yeah, I gotta believe hotels are just gonna get hammered right now.
There was a time when they were doing really poorly, but that has also increased. I think people are cautiously getting out and traveling. I did the same myself recently. I think do it responsibly, people are starting to feel a lot more comfortable in that area. So I think that's one reason that the VRBO/Airbnb space is doing well. But hotels have also seen less vacancies recently, and it's also a traditional time to travel in the summer. So I think there was a little uptick there as well.
All right, guys. Well, thank you so much for giving us all that information, answering those questions. And to our viewers, we appreciate you. You will get a copy of this. Make sure to sign up on our social media so that you can stay tuned when we post new videos, give you updates of upcoming events. And then also the articles that Wade mentioned earlier. We share a lot of relevant articles that you can read throughout the week. All right. Well, thank you guys so much and have a wonderful week.
Thanks, everybody.